Hello and welcome back to another TLC Tutoring Company accounting lesson. If you have not subscribed already, please be sure to do so as we are going to be pumping out tons of accounting videos during the next few months, and we are always open to suggestions about what we should create next. So let's take a look at this problem that we have here today. We are dealing with disposing and selling fixed assets. So in this case, we have a piece of equipment that was purchased on January 1st of the first year for $450,000. The equipment had a residual value of $50,000 and is expected to have a useful life of 5 years. And it also tells us that the company depreciates this equipment using the straight line method. So we have a couple scenarios. The first one is going to be a disposal and the second one is going to be a sale. So in this case, we have equipment that is going to be disposed on January 2nd of the fourth year. So notice, this is the beginning of year 4. So if it's the beginning of year 4, how many years have we owned this equipment? Well, we owned it for the entirety of year 1, the entirety of year 2, and the entirety of year 3. So far, we have accumulated 3 years of depreciation for this equipment. So in order to sell it, we need to know a couple things. One, we need to know the balance in the equipment account that we're selling, as well as the balance in its related accumulated depreciation account. So just to start off with, let's review straight line. So the formula for straight line is cost, in this case, $450,000, minus residual value, $50,000. And we have to divide that by its useful life of 5 years. So we know that each year we depreciated this piece of equipment for $80,000. So now let's find out what the actual balances in each of these T accounts are, and then we'll work on our journal entry. Well, keep in mind, whenever we purchase equipment, we always value it at the amount that we paid for it. So if we paid $450,000, that is the balance in that account. It did not change. Remember, when we do record depreciation, we debit depreciation expense and we credit accumulated depreciation. Nowhere on that did we change the actual amount in the equipment account. So here we have a $450,000 debit balance in equipment. Remember, it's a debit because that is the normal balance of assets. And now we also have to determine what the balance in accumulated depreciation is. What did we do during those 3 years that we owned the equipment? Well, in year 1, we would have debited depreciation expense and credited accumulated depreciation for $80,000. And what about for year 2? Well, we would have done the exact same thing. What about for year 3? Still, we would have credited for $80,000. So here, now we see that we have an ending balance in this account. Just so you can kind of see the math. 80,000 plus 80,000 plus 80,000, 240,000 in that account. So now let's talk about what happens when we dispose of this equipment. So on January 2nd of the fourth year, we are getting rid of our equipment. We're not receiving any cash for it. We're not getting anything special. We're just getting rid of it. So let's say that something happened and we just disposed of it. It's rare that something like this would happen, but it does happen occasionally. And this is a good reiteration to show you what happens when we do dispose of an equipment. So the first thing to take a look at is, what are we getting rid of? Well, we are getting rid of our equipment. So how are we going to get this $450,000 off of our books? Well, we do the opposite. We credit equipment to decrease it. So I'm actually going to cheat and kind of give you a little heads up that we are going to go further down to the third line, and we are going to credit equipment here for that $450,000. Okay, now that we have this equipment for $450,000, now we have to take a look at what else we need to get rid of, which in this case, what account is always tied to equipment? Well, it's accumulated depreciation. So our accumulated depreciation currently has a balance of $240,000 at the beginning of year 4. So how do we get rid of that? Well, we debit it for $240,000. So let's debit accumulated depreciation for that $240,000. Okay, now as you know, we can't just walk away from this yet. There's something missing. We're not balancing. So we need to take into account what is going on here. So We have 450,000 in our credits and 240,000 in our debits. So what we need to do is we need to plug something in the one that is smaller. That will make it balance. And how do we know how much to put in? Well, we have 450,000 in our credits. We only have 240,000 in our debits, so we need the difference. So $210,000. Now here's the fun part. What do we call this? We know it's a debit. We know that we dispose of equipment, but what is this going to be? So try thinking about the different accounts. What do you think it will be? Try pausing the video. Okay, so in this case, since we're getting rid of this equipment, this would be a loss. So losses are debits, gains are credits. So if you find that you have to debit your plug account in a disposal or sale, that will be a loss. If you have to credit your plug account, that will be a gain. So usually, since this is a disposal, the full title of the account will be something like loss on disposal of equipment or something of the sort. So pay close attention to your textbook and see which one they use. Okay, now that we've taken a look at a disposal, let's move over to scenario 2. Now in this case, we received a little bit of cash for this. We received $250,000. This one's going to be a lot more fun. So a lot of the scenarios didn't change. We still have $80,000 of depreciation every year because it's still the beginning of year 4. We still have a balance of $450,000 in our equipment account and $240,000 in our accumulated depreciation account. Oh, 1 second, just saw a typo. That would drive me insane. Okay, and we also know that we're receiving cash now. So really the cash is the main changer here. So let's take a look at what that cash does to our journal entry. So since we know cash, we're familiar with cash, we've been through the majority of accounting 1 at least by now. Let's start with cash. If we're receiving cash, what is happening to cash? Well, it is increasing. And remember, cash is an asset, so how do we increase cash? By debiting it. So I'm going to start there. Debiting cash. Okay, and how much cash are we receiving? $250,000. Okay, now let's take a look at those other pieces. Well, what is happening to our equipment account? Is it going up or down when we sell it? Well, it is going down. So I'm going to go ahead and again skip to this third line here, and I'm going to credit equipment for that $450,000 to make it go down. Now remember, whenever we kill equipment, we also have to kill its related account of accumulated depreciation. So how are we going to get rid of this accumulated depreciation? Well, we have to debit it by its balance of $240,000. Okay, now here's the fun part. As you can see here, our debits and our credits do not equal. Let's do some math up here just to kind of show you what's going on. So right now we have a total of $490,000 in our debits, and we only have $450,000 in our credits. So what do we have to put in our credit column to make this balance? Well, we have to do the difference, and that would be $40,000. Now here's to see how much you remembered from that first one we did. If we have a credit plug, what are we going to do in our journal entry? Well, a credit plug for the sale or disposal of assets, that is always going to be a gain. In this case, we're selling equipment, so this would be gain on sale of equipment officially. Okay, so try practicing these a few times. Go back, see if you can do it on your own, and then rewatch the video. Remember, if you have any questions, please feel free to leave it in the comments below. And if there is something in particular you want to see, please let us know. In the meantime, happy studying, and thank you so much for watching.